Hi there, this is Marc Levit again with ML Advisors. Today we're continuing to look at the journey of Ava the entrepreneur, who's launched an RTD brand. We've decided that she's going to raise money from friends and family. We've determined the amount of her raise. We've discussed the different instruments that she may use in her raise. And in this section, we'll discuss how to think about valuation and eventually next steps for her brand. So how do you set valuations for early stage brands? Well, at this point in time, setting valuation is a lot more art than it is science. The first way is simply looking at what valuations other beverage alcohol startup brands with, let's say, under 300,000 in revenue are raising capital, the comparable capital raises. And I would say the sweet spot here would probably be pre-money valuations between $2 million and $7 million. Second method, a scorecard or a Burkas method, is a way to quantify what are typically unquantifiable metrics, such as the experience of the founding team, successful launch of a product into market, and maybe the overall market being large and growing. And each one of those gets a check mark and an associated value assigned with it. You add them all up and you see what the value is. But typically at this stage, I tend to see what are called old school handshake deals, which are within the framework of those comparable capital raises. And it's all about finding a fair number between the investors and the founders. The investor isn't going to want a 1% share of the company for $500,000. It just doesn't make sense to do at this stage. Whereas the founder doesn't want to sell 80% of their company today at, frankly, any price. So those are just non-starter deals. And what happens is there really becomes some silent iterations in silent sort of ways to get to the middle of this, where a deal appears that is really interesting to both parties. And typically it's in that 15 to 35% range at this point in time. So what a lot of founders ask about and talk about is, shouldn't I be raising capital at the highest valuation I possibly can? And the answer is, well, yes, but it also depends. If you're going to raise at a higher valuation, you're giving away less of your company today. But alongside that lofty valuation comes some pretty pressing demand for fast and aggressive growth, high multiples on capital raises in the future, which are going to be more difficult to do, higher shareholder activism as they really try to protect their investment, and ultimately an exit. There's going to be a narrower range of acceptable outcomes. So if you're in for this type of journey, that's great, and raise money at as high a value as you possibly can. Most founders I work with try to find that middle ground where it's something that's attractive to both investors and founders, but allows the company to grow at a rate that is kind of more natural to the company. So now that we're toward the end, let's play Ava's scenario forward in more detail. She's secured funding from her friends and family. She's chosen a safe to do so. And she's been able to put this brand on a $2 million annual sales run rate. She's thrilled with the work she's done, her team's done, the investors has done, but she sees a much bigger opportunity, a $10 million revenue opportunity in the near future. And she wants to raise capital to approach this. So where can she get the money now? Maybe the company can throw off additional capital and she can fund this herself. Or maybe her friends, family, and angels want to double, triple down and take care of this raise on their own. But at this point in time, with this revenue and traction, the avenues of private equity, venture capital, and strategics are wide open. And she may be able to receive a value add investment or acquisition from any of these groups. Well, thank you very much for following along with Ava the Entrepreneur and her RTG Paloma. Should you have any questions about this or for your own brand, please don't hesitate to reach out, and email or call. Thank you so much.